Hey everybody, coming at you from New Zealand. It's pretty dope over here, like it so far. A little chilly though. Well, I hope all you guys are having an awesome week so far. And I just want to kind of jump into it, bring you some of the market news I've come across recently. So I'll go ahead and jump right into it. I don't know if you guys have been watching the markets or market news, but recently something that caught my attention is the company Credit Suisse, which is a major financial institution in Sweden. It's like a very, very, very large bank, uh, huge bank that provides financial services, everything from credit cards to banking to investments to you name it. They're pretty big. And they have connections to Goldman Sachs, Bank of America, Vanguard, and many other global and American institutions. So if something bad were to happen to Credit Suisse, it's bad for the global economy. So what I've noticed recently is that credit default swaps for Credit Suisse have been exploding. What are credit default swaps? So credit default swaps are, in this case, bondholders or creditors of Credit Suisse are buying credit default swaps, assuming or predicting that Credit Suisse will not be able to pay interest to their creditors in the future, meaning that Credit Suisse will default. And if they default, they would go bankrupt, meaning that creditors can go after Credit Suisse for not paying them their interests, in this case, bondholders. So credit default swaps are basically a contract between a buyer, the creditor, the bondholder, and the seller. So the buyer of the credit default swap is buying insurance from the seller of the default swap in the case that the company, or in this case, Credit Suisse, will not be able to meet their liabilities. So it's almost like insurance in the case that Credit Suisse defaults on their interest payments. And recently, credit default swaps or Credit Suisse have exploded. The reason why credit default swaps are kind of scary because it is in the derivative market, which is a $3.5 trillion market. And this was what caused the global financial crisis in 2008. It was where it all systematically began. Why? Because, again, institutions were handing out mortgages, and then they would then sell these mortgages to other institutions or entities like Freddie Mac, Fannie Mae, who would then package the pool of mortgages into mortgage-backed securities and sell them off to investors. And then these investors would go on to the derivative market and insure their risk with sellers of credit default swaps. So when it all began to go, when everything began to really hit the fan, it began in the credit default swap market, the derivative market. And again, this is not really the extent to where this is potentially rooted or tied to is unknown. So I'm just curious what kind of potential global effects, which are not going to be good regardless, this might have. Because like I was saying, Credit Suisse has connections with major American and global institutions that if something were to occur to Credit Suisse, it's going to hit everyone. And it seems like another domino is about to fall. Reason I say that is because no one's talking about the collapse of Evergrande, the massive real estate developer in China. Again, they had massive connections to major global institutions that lost billions of dollars in that hellstorm or whatever you want to call it. And recently, earlier in this year, after this the beginning of the Ukrainian war with Russia, the United States sanctioned Russia and completely obliterated their capital markets. The Russian equity markets are like in the floor right now. They collapsed. They're below 2008 levels. And why is this important? Because a lot of American institutions lost billions of dollars in that collapse. BlackRock, which owns everything, lost billions and billions of dollars in the Russian equity market collapse. So I'm curious to what extent this might potentially lead. So that as of now is really just me talking. So I guess I'll just provide you with actual visual proof to show you what I am talking about. So I'm going to share my screen here right quick. And as you can see here, this is recent. Credit Suisse credit default swaps are above 2008 levels. They have skyrocketed recent about like I don't know, 400 basis points in such a short period of time. That's pretty crazy. So creditors, bondholders of Credit Suisse are predicting that Credit Suisse are not going to be able to pay their interest in the near future. So they're buying insurance in the case that Credit Suisse defaults. This is a scary situation. I don't know to what extent this leads, but again, Credit Suisse is connected to a lot of major American institutions. So if Credit Suisse goes belly up, it's going to affect the global economy. Another crazy thing that I've been seeing, and it all starts in the derivative market. The derivative market is the largest market in the world. It's massive. It's where all the hedge funds, all the major institutions, all companies, big companies go to hedge or protect themselves, buy insurance or all kinds of other instruments. So this chart here, if you can see it, is the United States Schiller Home Price Index. It is currently in backwardation. What is backwardation? Backwardation is when current prices of an underlying asset is higher than trading prices in the futures market. So, for example, in the real world, currently housing prices remain elevated. However, the derivative market or the futures market is saying the opposite. If you see here, this is a bad looking chart. This is the housing crash 08-09 levels. This thing has just been completely dropping, and typically it all begins in the derivative market. The derivative market foreshadows what the actual market might potentially do in the future. So this is not good for housing prices. Again, I don't know. This is just like, again, like I was saying, these little red flags that are popping up, or little signals that are popping up around the market that are kind of telling you, hey, something is not right. But yeah, I mean, that's basically some of the things that I've seen recently that are kind of scary. Again, if you want to look at this chart, it's USCSHP, and it's derivative market. It's in backwardation, meaning that this is below what current housing prices are in the actual market. But the derivative market tends to foreshadow what the actual market's going to do in the future. Not always, but people use it as a potential indicator to see what might happen in the actual market. The last couple of days, the stock market, or the broad market, Russell, NASDAQ, S&P, Dow Jones, been rallying pretty hard based off the fact that there's like this news out there that the Fed might pivot and stop raising rates and reverse. However, the Fed has not made any announcements that they might do so. The news came from the European Central Bank warning the Federal Reserve to stop raising rates because something's about to hit the fan. Europe is in big trouble right now currently, and winter is going to be very ugly for them because Europe just announced that they're going to pivot and they might potentially lower their rates. But this is scary because what is keeping a cap on oil prices is rising rates. Stronger currencies, stronger dollar is what is currently keeping the lid on high energy prices. And OPEC recently announced that they're going to cut down production to kind of bring oil prices back up because they were dropping dramatically recently. So now OPEC's reducing global oil production, and you have European pivoting and advising that they might potentially drop down their rates, and winter is coming, no pun intended, for Europe, which means they have to use more energy to keep homes warm. It is a scary situation. I don't know what any of this is going to lead to, but based off of what I'm seeing, it's not going to lead to something good. Because it's, I don't know. It's just like another domino popping up and another signal of, hey, be freaking careful, because the markets are signaling negativity. I don't like bear markets. They're a pain to make money. I love bull markets. It's always easier to make money in the bull market than it is in the bear market. But all these signs are popping up. So it's telling you to be careful, watch your back, because this might potentially hit the US economy, and it's going to hit 401ks, it's going to hit pensions, it's going to hit all kinds of retirement accounts. So with that being said, I'm just saying be conservative and protect yourself. Why am I showing you these charts? Because the market has been rallying pretty hard. Recently, by rally, I mean going upwards, which is ironic because the news has been very negative, yet the market is like I look at it like a kid throwing a tantrum. And again, I use technical analysis for price action or historic price action. I don't really use them for any predictor or anything, but I have come to learn it. And give you an example here. You can kind of see this little area have that little yellow alert tag at. As per technical analysis, this is a major point of resistance, and this is a long-term chart. So if price action were to go below this chart, technically, they would continue going lower and lower, because that's an area of resistance, an area where the price seems to be stable. So if prices were to come down and cross that area, it's going to be very ugly for everything, 401ks, pensions, you name it, because all pensions, all 401ks, all retirement accounts are linked or invested in one of these major indexes, such as the Russell, NASDAQ, S&P 500, and Dow. So with that being said, I'll leave you to what you think is rational, and let me know what you think. Again, I have been looking for good news, but all I see is negative news. So I don't know, share your thoughts with me and let me know what you think. And I would really appreciate that. And thank you for sticking around and watching this video. And I'll see you soon. Hope you have a great week. And again, I'm just sharing with you what I'm finding. So hope you have a great week. And I'll see you soon.